Hey everyone, welcome back to Indicatorlab. My name is Kika. I'm a co-founder of this channel. Today we're going to talk about a very commonly known concept, the divergence signals. We run a very comprehensive backtesting on three commonly used divergence signals, the RSI, the MACD, and the MACD histogram. We're going to see how they perform. First of all, let's talk about divergence, what it means. People have a different understanding of it. Here, we're just presenting our understanding of divergence. So first, divergence, you need to have two signals. Typically, you compare the price versus another indicator. Could be RSI, could be MACD. So here in this chart, we see the Bitcoin is making new highs on this daily chart. We have three new highs. Meanwhile, on this MACD signal, this blue curve here, it is making lower highs here. Therefore, we observe a divergence. This is a bearish divergence. Traders may be using this kind of signal for the setup for short side. And in the case of long setup, during a declining trend, the price is making newer lower lows like this. However, the indicator is also making low, but it's higher lows. So then we have another type of divergence, which is bullish, because price is making new lows, but indicator is not. So this is a bullish divergence. Overall divergence signal, it is a reversal signal. It describes a potential ending of a continuous trend. For example, in this case, Bitcoin is still making higher highs, but there may be an exhaustion of this momentum, and then at some point it starts to do this reversal. Maybe it breaks this trend line, or maybe it retested a previous resistance and it shows a lower high. That's more detailed trading strategy setup. But overall, a lot of traders use divergence as a preparation signal for their trade. So that's really it. That's our understanding of the divergence. And here we talk about a specific definition. This is more related to coding because in Python, you really need to tell the program how to identify a divergence, really like line by line. So in our case, our first step, we identify the peak and valley, like these high and low points in the indicator chart, not from the price chart, but from the indicator chart here. So in this case, this is a MACD, and the blue curve is the MACD, and the yellow one is the MACD signal, which is a moving average of the blue one, and then you have the histogram here. That's really the three component of MACD here. So for the definition of peak and valley, we first need to confirm that this identified peak, it is really the maximum in the adjacent 20 candles, left 10 and 10 on the right. So in this small neighborhood, it must be the high. That's how we identify local peak or local valley, similarly here. And for the most recent potential peak and valley, we only require the chart to show three candles on the right hand side to establish a potential peak and valley. If we wait till 10 candles, that maybe it's too late. We wanted to have a signal a little bit earlier. But if you just use one or two candles to establish a potential peak and valley, you might encounter a lot of false positives. Like here, maybe it dips a little bit, but then it goes up right away. So we find three candles is probably a good balance. This is a little bit subjective, but it works. We checked our charts, it looks pretty reasonable. All right, once we have established a trend in the indicator, for example, here, this is a downtrend, we go back to the price chart here, and we find the corresponding price for the peak and valley at the same point where you have these peak and valley from the indicator. So that's the close price here, this is the closing price here, and we apparently can see that for point A, and point B, the price is actually making a higher high, while the MACD is actually making a lower high. That's a very obvious divergence, and it's a bearish divergence. And now, once we have established a divergence, we can now define our entry and stop. So for the entry, in this case, this is a bearish divergence, so we'll be leaning towards the short side, and the entry will be the low of the recent four candles. So 1, 2, 3, 4, and the low is here. Once the price breaks this low value, that's our entry. And then at the same time, our stop is at the high of these four candles. So that's here. So here's your stop and here's your entry. This is really your risk. And potentially we're hoping the price will drop down a lot, give us some nice profit But here's the overall setup. Same for the long side. And here for the indicators that we tested in today's video, we picked the most popular 3 indicators, the RSI, the MACD, and the MACD histogram. In terms of the data we tested, we used 150 perpetual future trading pairs on Binance, and we used their 1-hour chart ranging from 2019 to right now, 2022 November. So that's a very comprehensive backtesting. On my computer, it's a pretty good gaming computer. It takes about 6 and 8 hours to finish one run. So very, very exhaustive. That's good. And then regarding the position management, we use separate accounts for long and short. For each account, we use the same starting fund, $10,000. This is a simulated account, of course. During the entire backtesting, we used an effective leverage of 1 time. So basically no leverage. This is more like a spot trading. So in terms of the portfolio management, like how we balance different symbols, we use the rebalancing strategy. So for example, let's say right now we have ABC, these 3 symbols in our current position, and it's already 100% of our current position. Right now, at the close of this new candle, we have a single symbol D that also fits entry criteria. Then we'll just close part of the ABC position and then open a little bit D position, such that A, B, C, D, they have a equal balance in our total position. So this way we won't miss any qualified entries. Meanwhile, we will not over leveraging our account. And lastly, we tested different reward risk ratios, 1, 2, 3, 4, 5. We're curious how different strategies perform under different reward risk ratio setups. So that's really it. Let's take a look at the results. Here we have lots of plots. On this chart, we have 2 panels. Top panel, that's for the long side. Bottom panel for the short side. And their starting fund is always 10K. And this is starting from 2019-ish here. And it ends at 2022. Here we have the signal name, MACD, and RRR is the risk reward ratio, which is 1 here. And here is for RSI, 1 times reward ratio. And this one is for MACD histogram. So that's the 3 names abbreviation here. So I'll just go quickly through these charts because we have 3 indicators and 5 different risk reward ratios. So we have in total 15 charts here. I'm not gonna spend a lot of time on each of them. And if you're interested, feel free to pause the video and take a deeper look. All right, here we go. We'll start from RSI, MACD, and then MACD histogram. And we'll start from low reward risk ratio from 1 to 5. All right. So that's all the results, and we do have some preliminary observations. So first, we find that divergence is really a profitable signal. We have tested different signals in the past, such as the golden death cross of MACD. They really don't work that well. Here, we can really have those 10x profits here, starting from 10K to 100, more than 100K. This is very realistic gains. And particularly these high gains, they happen at high risk reward ratio, right? Because this is a reversal signal, you really should aim high. Maybe you will have lower win rate, but overall that's the best way to optimize your reversal trading strategy. So here in particular for RSI, and if you have 4 times reward risk ratio, you can start from 10K to almost 140K. That's a 14 times return without any leverage. That's very amazing. And if you check MACD, it made its way from 10K to 100K. Not as good as RSI, but still not bad. Relatively speaking, MACD histogram, it's not that good. It's only going to 35K. Still good, but not that good. And I think for MACD histogram, the best risk reward ratio, the long side, is 5, and it goes to almost 50K. Now on the short side, if you have a low risk reward ratio, it kind of preserves your capital. It won't give you huge returns. But if you go with a high risk reward ratio, it really tanks down. It goes from 10K to almost like what, 1K, 2K-ish. So not good. So as a quick summary, we find that Divergence is really a profitable signal. And in terms of the relative ranking between RSI, MACD, and MACD histogram, this is what we find. RSI and MACD are pretty good overall. RSI is a little bit better, but MACD histogram, yeah, it's just a so-so. And regarding the optimal choice of the risk-reward ratio, for long, we should aim high 4 and 5 times return, and for short, maybe just aim low 1 and 2 times return. Alright, so that's really it. I hope you enjoy this video. Here at Indicatorlab, we customize strategies. We provide real-time trading signal alerts. So for these divergent signals, we will share them in our Discord channel. So feel free to scan the QR code and join the channel to get these free signals. Thank you for watching all the way through our video. Until next time, enjoy trading.